So this is one of the first webinars at Paterson. We've done before some webinars through the repeating brand, which I was managing earlier. But first such initiative at Paterson, and we're hoping that this effort is a quarterly effort. But obviously, we'll sort of take feedback from you guys in terms of how the content is, and then figure a frequency. Don't want to end up boring everybody too often, or showing up here alone and talking alone. Um, so yeah, so because we've done this in repeating quite a bit earlier, and we've got a few people from repeating as well, I thought it's great to sort of just introduce Pattison, because the transition happened last year, and a lot of people, while they've got background of Pattison, it's good to just get a refresher. Pattison actually has been existing since the last 90 years. It's a legacy brand, one of the larger companies in South India, and primarily started off as a stockbroking company, but now we're a full-fledged financial services firm. We entered the wealth management about a year and a half back. So now we've got a full suite of products across stockbroking, wealth management, which consists of mutual funds, insurance, fixed deposits, bonds, portfolio management services, investment advisory, applying for a research license as well. So we're expanding pretty fast in terms of the products and services that Pattison offers. Also, one of the changes that's happening at Pattison that we've been actively driving is moving towards a more actively advised and managed model, wherein we just don't want to facilitate transactions for people or be a commoditized broker, but we also want to add value to people in terms of where they should be parking their money or what they should be doing with their money. So there is a lot more focus in terms of research, advisory, and in general, hand-holding investors across their investment journey and wealth creation with us. For those who've joined from Pattison and don't really know who I am, I'm going to just briefly talk about myself for a couple of minutes as well. So, brief background is that I have been a research analyst for most of my career across the sell side as well as the buy side. And started my own investment advisory company about 4 years ago. And then got into a venture with Pattison for the PMS business. And now repeating, which was the business I started, as well as PMS are sort of both integrating into Pattison as we speak. So I have been actively part of Pattison for the last 9 months, but on an ongoing basis for more than almost about 2 years now. In short, at this point in time, my responsibilities span across quite some areas, primarily research, some bit of sales and marketing, a lot of customer relations, and some amount of strategy as well. Don't want to dwell too deep into this, but we've got some people from Pattison on this call as well. We've got Purnima, we've got Prasanna, Siddhant, Chaitanya, as far as I can see, some more as well. Sorry if I've missed you guys, but if I get stuck somewhere, anything about Pattison or anything about anything that comes up in the Q&A, I've got some assistance here, hopefully. So yeah, let's begin. I think the topic was, will 2026 see a revival in Indian equities? 2025 has been a pretty challenging year, and I want to start with that. Before even coming to the outlook of 2026, it's important that we understand what the problems or issues faced in 2025 were. Now, on a broad basis, I think everybody would agree that it was a tough year. The headline numbers looked great, with the Nifty ending the year at about 9 to 10% returns. However, there was weakness seen across in the broader markets. And this can be seen if you look at this chart here. Mid-cap returns were lower than Nifty 50. Mid-cap 150 returned about 6% last year. But there was immense pressure seen in the small caps, which actually declined by 6%. So there was immense polarization seen in the market where a bunch of stocks did well, but the rest of the market really had a lot of fatigue and a lot of weakness seen. And this naturally reflected in everybody's portfolios as well, whether it is investor portfolios that we advise or even our own managed portfolios. It has been an extremely difficult year, even for the fund managers and portfolio managers, to consistently deliver alpha throughout the year. Um, and that can be seen in some other places as well, some other metrics also. One of the very interesting stats that I came across was that 8 out of 10 stocks in 2025 failed to beat even the fixed deposit return of about 6.25%. The last time that this happened, that the number was so high, was back in 2018 and 2019. So obviously, investors have been pretty spoiled post-COVID in terms of stock picking. Anything that you pick up would have, in all likelihood, given great returns. But this year, like 2018 and 19, has been pretty hard in terms of just a few select stocks beating returns, even at an FD level. And FD is still 6.25%. If I have to look at negative returns, about 55% of the stocks in 2025 gave a negative return. Slightly hard to read this chart, but let me just say that this 24% of the stocks basically declined up to 15%. 29% of the listed stocks have declined 15 to 30%, and about 2% of the stocks have declined more than 50%. Effectively, these three combined comes to about 55%. Just to give you some context, in 2024, 24% of the stocks had given negative returns and 76% of the stocks had given positive returns. So the advanced decline ratio has pivoted towards the decline side in 2025. Now, naturally, the reality we all know when we look at our portfolio returns that Nifty, despite it touching its all-time high, our portfolio may not be reflecting that, and that's the pain that everybody is going through, including us. Now, this reality is not just true for domestic investors, but also at a global scale. So India has underperformed globally. Sometimes you are in a situation where, I mean, most of the years in the past, India has outperformed. However, this was one of the years where India actually underperformed massively. It was actually one of the worst performing markets globally. So here's a chart that sort of gives you returns for Nifty versus major indices across the globe. MSCI World is about 21% up. So look at it as global markets rose by about 20%, 21% in 2025. Emerging markets actually did better at 28%. So ideally, India should have done better or at least hit that average, but we were at a dismal 9%. While this looks bad on the chart, I think one of the things that makes it even worse is the fact that the Indian rupee depreciated by about 5% against the dollar in 2025. Now, from a global investor's perspective, whenever somebody is investing in India, they have to take their money back as well, right? So effectively, what happens is that in USD terms, considering a 5% depreciation in rupee, their real return would have been close to about 4 or 5%. So while the local currency return looks okay at 9%, 4 to 5% is absolutely dismal because somebody sitting in the US, why would they take exposure to an emerging market giving 5% return, which has so much risk compared to just locally investing and earning 20%? So the math just didn't make sense for a global investor as well. Um, yeah. And at the end of it, emerging markets itself, there was a very large opportunity last year because 2025 was one of the very few years, at least in the last 5 years, this was the first year that emerging markets outperformed. Generally, the trend was that the USD itself has depreciated by 9%. So since Trump's come into power, etc., the USD has been devalued quite a bit relative to other currencies. This is what made actually a strong case for emerging markets because the US could see better returns outside of the USD itself was depreciating. However, we've not been able to sort of ride that wave at all. Just giving a bit of a comparison with other emerging markets, just so you get context. Returns have been amazing across. South Korea actually was one of the best performing markets. Major themes that played out were AI and an improvement in corporate governance in terms of reforms. And the third theme that played out was also commodity prices rising, and that benefiting any market which has a decent exposure to mining, metals, resources, specifically South Africa and Brazil. So these two gained because of commodity prices. South Korea, Taiwan, and China were equally strong markets because of a strong play on AI, as well as corporate governance reforms across these markets. India, unfortunately, could not really participate in any of these themes. And that's what brings us to what really didn't work for India in 2025. Now, I'm going to spread this discussion across five broad points that didn't really work for India. In fact, they were detrimental to India to a large extent. The first one being currency. As I mentioned, the US dollar itself depreciated by about 9%. And while most of the other currencies appreciated against the USD, the Indian rupee actually depreciated by 5%. Primary reasons for the currency depreciation were twofold. There is one, which is the capital account deficit, which is primarily your portfolio foreign investors exiting. And the second reason being there was a current account deficit as well, where simply put, imports are exceeding exports, and that gap between imports and exports is widening. Gold and crude both played a significant role in terms of the current account deficit widening for India last year. So this was one major reason. Second reason why India underperformed massively was foreign fund outflow. So throughout 2025, there was a lot of pressure because of foreign funds just plainly simply exiting India. India was just not part of their target market in terms of investing. $19 billion is the fund outflow for 2025. This is particularly steep because if I have to sort of look at the cumulative outflow over the last 5 years, it's actually coming up to about $11 billion. So 2022, 2024, and 2025 combined is more than negating the inflow that we've seen in 2021 and 2023. So India has not been a preferred market despite its strong performance at a global level over the last 5 years. And that obviously puts a lot of pressure on the Indian markets. The third thing is trade uncertainty. India is currently slapped with about 50% tariff from the US. There is a 25% reciprocal tariff and an additional 25% tariff as a penalty because we're buying Russian oil. So since August 2025, India is effectively paying 50% duty, which is amongst the highest in the world. And against this backdrop, I mean, at the end of it, we are all the countries are seen managing the situation pretty well, including India. Because I'll give you an example of China actually. Just last month, it actually broke a trade record because China exported about $1.2 trillion worth of goods, more than it imported last year. So it's actually seeing its trade surplus widening despite having US tariffs there. A couple of things that they're doing right. Number one is that shipments to US fell by about 20% for China. So the exposure of US has actually come down significantly for China. That's number one. They have made up for this exposure by exporting all across the world, whether it is LATAM, Africa, Asia, Europe, everywhere. Chinese goods are flooding in to make up for the loss that the US markets are giving them. The other thing is that China is exporting a lot more big ticket items like cars and ships and semiconductors and stuff like that. And because of that, they're able to actually do more high value goods compared to toys and clothes, which were predominant previously. So this dual strategy has been working amazingly well for China. And while Chinese cheap goods are sort of flooding a lot of markets, naturally they're also bound to cause some political stress and pressures, a lot of pushback and a demand for tariffs, especially from countries like Europe. But if you look at it from the other angle, what's also happening is that cheap Chinese goods are also helping inflation be low in European countries. Estimates say that in the UK, for example, inflation can be knocked off by about 0.2% just because of Chinese goods being cheaper than domestic production. So this is helping a lot of countries maintain lower inflation, and it's not really a complete loss for a lot of countries. India, however, I think on the other hand, while we've been able to manage trade pretty well on the export front, imports are the bigger problem, wherein crude imports and gold imports are both causing our trade deficit to widen, and that's been a big issue for 2025 as well. The fourth one is AI. This has been the buzzword throughout. A lot of you, and including me, we use AI on a daily basis, and we're actually seeing it proliferate in front of our eyes. A lot of the global rally is currently being led by AI, whether it is the US market or in India, whether it is China, Taiwan, South Korea. In effect, if you look at emerging markets, the four major constituents in emerging markets are currently China, Taiwan, South Korea, and India. All three, which is South Korea, China, and Taiwan, have been benefited by the entire AI play. Whereas in India, there is absolutely no play when it comes to AI. There are some indirect plays, but again, it's a pretty small proportion of their overall revenue, and hence the Indian market has not played this rally at all. Globally, this is an actually interesting chart that I found, which combines the market cap of all AI related stocks across US, China, and Taiwan and divides it by the total market cap of those three markets. And we see that they constituted to only about 6% of the total market cap back in 2016, but now they constitute for about 22%. So the meteoric rise that you're seeing in tech stocks and AI related sectors is actually driving a lot of the incremental growth for the markets. India currently, if I have to compare and look at the situation, forget AI, even if we have to look at slightly more digital plays or new age tech companies like Zomato, Swiggy, Grow, Cartrade, and all of these. If you look at the combined market cap of these companies, it comes to about $120 billion, which is roughly 2.5% of our total market cap. In contrast to this, if you look at the US, the Mag 7, which are the top seven companies tech driven, put together have a market cap of about $21 trillion, which is nearly 60% of the US market cap. So even if we are present in high growth, slightly sort of hotter segments, they are a very, very low proportion of the Indian market, and hence we're not really able to participate in this rally altogether. And the last bit, or the fifth point, which is, I think, the most important when it comes to any market performance, is earnings. At the end of it, if you're not seeing growth, there is not going to be a valuation that is going to be assigned to that market, and hence the market is going to be under pressure. If I have to look at FY, the last 3 or 4 quarters, we've delivered single digit PAT growth at an aggregate Nifty 50 level. Now, coming into 2025, sorry, 20, yeah, about Jan 2025 last year, India was one of the most expensive markets globally. And being one of the most expensive markets globally, you cannot deliver 4 to 9% PAT growth. It just doesn't justify valuations delivering that kind of growth. Effectively, at least since September, what has happened is that because we've not delivered growth, but the markets have remained stable, our valuations have eased out or cooled off a little bit. But still, trading at premium valuations with subpar growth is just something that does not work. So having touched these, I think I want to finally come to why 2026. One is, okay, 2026 looks better in our opinion. I'm going to touch upon why we're saying what we're saying. And we think that India is going to outperform compared to the global markets in 2026. Now, one is that all the factors that we mentioned as problem areas for 2025, we see a scope of improvement or resolution happening in most of these factors in 2026. I'll start with currency. The rupee has been the worst performing currency in Asia last year. From here, we see some amount of stability. especially if your view is going to be that USD is going to continue to drag and continue to be under pressure. Looking at the geopolitical situation as well as the randomness in a lot of the decision making at the top level, we think USD can still continue to drag, and hence rupee can see some amount of a normalization. Um, Also, a major assumption in this, or one of the factors, is that with crude at $60, we don't really have a current account problem. If that does not really pan out, or if crude does not remain stable at around 60, then probably some more weakness can be seen. But otherwise, we can start expecting some amount of normalization happening. Usually, the long term trend is that the rupee depreciates by about 2 to 3% every year against the dollar. Last year was exceptional at about 5%. But the RBI also, we've seen sort of stepping in time and again whenever the gravity of that fall is very large. Our forex reserves are at an all-time high and they are very healthy. And the RBI does have the ability and the muscle to come in and stabilize currency falls whenever that happens. So overall, in 2026, we do see that the pressure of rupee that we saw in last year will reduce and come back to normal levels of 2-3% from the 5% last year. The second bit is flows. Now, flows, I think India has been a massive underweight for most global funds at this point in time. We were, in fact, last year talking about a situation where India and China were almost similar in terms of MSCI emerging market weightages, but India has sort of gone south from there massively. Now, there is a case for emerging markets to continue outperforming in 2026. And if that happens, asset flows are expected to continue towards emerging markets. And that is a trend that is actually likely to happen because currently global markets or global funds are still very underweight emerging markets. Emerging markets have not, in fact, performed well over the last 15 years. And now that there is some hope there, we expect continued flows into emerging markets. The only four relevant markets when it comes to emerging are China, Taiwan, South Korea, India. And if flows have to come in, India will obviously also get some more flows. So we're expecting the situation to moderate over the coming months. However, we're not as confident as the currency when it comes to flows. So I've given it a moderate probability with a 6 to 9 month sort of timeline. The third factor is trade. The major culprit here, obviously, being the trade deal with the US, which news has been that it's on the verge of happening, but that on the verge has been lasted for it's lasting since a few weeks and months. So we don't want to put a timeline to saying that it can be on the verge. It's always been on the verge. So, but what we're fairly confident of is that logically, somewhere in 2026, we should be able to strike a deal. And why that logic pays out even better is that currently we are paying higher tariffs than China. So unless the US no longer considers China as a strategic rival, this situation does not really make sense. So logically, we need to understand that I think this situation will also normalize. When in 2026 will it happen? That's as unpredictable, and you guys have sort of seen the unpredictability of decision making there. So we're not able to put a timeline to it. But in 2026, it happening seems very, very likely. The fourth is the AI bubble. Not the bubble, I don't want to call it a bubble. There is a natural tailwind, and that tailwind was for direct AI companies sometime back, and now it's flowed into ancillary companies as well. The theme may not really come to an end, but a wobble is likely because usually what we've seen is that in any hype cycle or in a new trend, initially there is a lot of frenzy of investors moving towards that hype cycle and investing heavily in it. And then there is some normalization or correction which normally meets expectations. So whatever has run up beyond expectations or has gathered steam because of a lot of demand, usually there is a little bit of a cooling off period and normalization of hot trends in the market. So we're not saying it is a bubble. We're not saying it is about to burst. We are just saying that in 2026, there can be some amount of rationalization towards how much money is being pumped into this, because at the end of it, investors will start looking at ROIs being generated on their investments on the AI front. Some bits of it have already started in the last year. If you notice, there has been a sort of cyclical movement of money with companies investing or buying revenue using capex. So some amount of rationalization has started to take place, I'd say, but maybe it could aggravate a little bit in 2026. If that happens, India turns out to be the obvious beneficiary because we are not really taking part in the AI theme at all. So if it were to go out of fashion or even slightly reduce in fashion, India becomes the natural option for people to invest in at a global level. And the last bit being earnings, we're already set to accelerate. What's happened is that the GDP data has been pretty encouraging. However, the one major factor that has resulted in the GDP data is that we've got a low deflator. So it was 0.5% for 2Q and 0.9% for 1Q. However, the average deflator over the last 10 years have been about 5%. With India's inflation target at about 4% and plus minus 2%, and with RBI's willingness to cut rates further, we see that inflation will start to normalize. And this can push our nominal GDP up back to double digits from the current 8.5% that we're reporting. So with that set, I think earnings are likely to also flow down. The other thing that will also help corporate earnings get boosted from the single digits that we saw throughout the last 4 quarters is that the government has taken a lot of step over the last few months in order to push consumption domestically. So whether it is income tax slabs being cut or GST rationalization or even from the RBI side interest rates coming off, a lot of factors have converged into the demand outlook being strong. Now this was pegged on to the third quarter. And third quarter, at least the basic reading that we get on ground and by talking to a lot of the FMCG companies is that not FMCG, but consumer facing companies is that demand is improving on ground and that is expected to reflect in results in this quarter itself. So that is something which is a very high probability event and is in fact already starting to play out and translate into numbers. And this being the most important, I'd probably associate or attach the most weight to the earnings factor. In short, all the problems that we're seeing in 2025 are likely to see, if not resolution, at least improvement in the coming year, which takes off a lot of pressure off the Indian markets in this year compared to last year. Um, Second is that India is a structural story at the end of the day. We are in a situation where India has given positive returns for almost 10 years straight now, barring probably 1 year where returns would have been flattish. For 10 years straight, we've delivered positive returns on the markets. There is no doubting, and I don't want to sort of go into that whole demographic and under penetration, unorganized to organized bit because that's a very known story. It just is something that will continue playing out over the next decade as well. India is one of those countries which has delivered double-digit returns consistently over the 10 years. If I have to look at the market cap CAGR for the last 10 years, India's after Taiwan, probably 13% is the highest it's delivered. Amongst emerging markets also, it's standing out. And we've got visibility of that continuing over the next 10 years. So the proof is not just in the fact that we've delivered in the past, but I think all of us here see enough around and are aware of how the demographics of India are to sort of be confident in saying that this will continue over the next 10 years as well. So India's at the end of it a structural story, and the current growth or cyclical play that's driving a lot of the global markets, if it has to shift gears, India is the place to be, and I think everybody's even at a global level sort of in agreement to that. Lastly, valuations. I think this is the most important bit because what you end up paying for the growth you're getting is what determines how the market will move. And that's exactly the situation we were in last year when valuations were at an all-time high, but the growth just didn't get delivered. Compared to that, now we're in a situation where if I have to look at Nifty valuations compared to its long-term average of 10 years, we are trading at the long term average. However, I don't think I want to focus too much in terms of looking at Nifty with its own historical average, because what's resulted in the underperformance for Nifty has been India versus globe. So I'd rather look at MSCI India valuations compared to the emerging market valuations. Historically, we've got about a 78% premium compared to emerging markets. And this premium has come off to about 55% right now. So valuations from that angle have cooled off massively, and are trading. So our premium is below our long period average of 78%. So I think from here, we've got enough cushion in the market in terms of valuation as well. Valuations don't really look expensive at this point in time when you put that in context with how the other emerging markets have performed. Um, so that's where we're at. In terms of strategy, I think I want to end this webinar with this one slide, which is India is currently a boring market. If you look at how things are going globally and where people are investing, India is probably not the most fun, not the most hot, not the sexiest market there is. However, I think boring, we're at this point or juncture where boring is great. India's structural story is in place. And the way we're looking at it is that in terms of plain strategy and positioning, there are 3 points I want to make here. One is that because the headwinds from 2025 are getting better, but we're not too certain about the timing. The perfect strategy to play the Indian markets would be to continue staying invested. It doesn't make sense at this point in time to exit, be scared, worry, or face any anxiety. It's better to stay invested because factors are getting better. So that's part one. Part two is that India seems to have enough cushion on the valuation front against the world. Even if the world markets were to become a little shaky in the next year, because we've underperformed in the last year and because we've got a little bit of valuation cushion, I wouldn't worry too much about India facing too much of a brunt, even if the world markets were to shake a little bit. So from a risk reward favorable situation, I think we're in a very favorable place. And the third thing is because of the disparity or polarization we've seen in the markets over the last year, there are several stocks available at much better valuations compared to where they were earlier. I think the last 3, 4 years have been a situation where everything has been elevated in terms of valuations. But at least in the last year, there has been a plethora of sort of opportunities that the market has thrown about. So it's a great time to pick up good quality stocks and position portfolios in a manner that would be able to make the most out of this cusp that we're at and benefit from the tailwinds that are coming in 2026. So with that, I'll take a pause. I think I've come to an end of what I wanted to share. But I'll open it up for questions if any from anybody. So open floor on questions here. We've got some in the chat actually. Maybe I can start with those while the others think of questions. Um, so sorry, one is. Okay, so one question is from Devendra Dhut. How does value migration theme small case adjust to the dynamic global uncertainty? What are your views on philosophy in this small case? So in this, primarily see value migration is one such small case which is meant to be dynamic in nature. It is meant to capture a lot of trends that are ongoing in the market. We've luckily got Prasanna on the call as well, who manages that small case directly. So probably I'll let Prasanna take a shot at this in terms of just answering in terms of where we are placed, how we've benefited over 2025. Because if I look at the performance of the small case in 2025, we've delivered about a 20% return in the last 1 year, despite the market being what it was. So I think I'll let Prasanna take the credit as well as the answer. Prasanna, you can unmute. Huh?
Yes, yeah. Good morning. So, look, the way Sagar mentioned what we have underperformed, but amid all this, there were good opportunities available on a sectoral basis. Okay, So the as we mentioned that the philosophy of value migration is very simple, means we didn't complicate it much. So we want to stay ahead of the curve and then enter a sector when not many are into it. Okay. So the way we had means when no one was there in automobile or auto ancillaries, we were heavy on auto and auto ancillaries. Even numbers were not good, but there was good value which was visible in leading companies, whether it is M&M or even Ashok Leyland or TVS. So those are the things where we found value. Now, last few months means we were focusing on metals, and a lot of queries were asked when we had exposure to Vedanta, especially in value migration. So, what were the reasons? And despite management having issues, the demerger got lingering, and still we kept on holding on that. So, actually, what happens is when we see value and the growth is expected to come in next 3 to 4 quarters, there we shifted our funds. Okay. Similarly, right now, as I mentioned that yes, when no one is speaking about IT or even FMCG is considered as a sector where not many are invested, we are finding good value buys in such sectors. Okay. Now, what we look for is a very simple fact is that so, what are the key areas where we should see growth? Okay, so there are key areas for each and every sector. So, metals, we were looking at the mining and even for various metals. Okay, so takeoff was there. Government was showing supportive. Government was supportive on that part. So these are the few factors which are supporting in long term. Okay, and apart from that, one thing which we focused on was like. Avoiding few sectors where government had higher interference. Okay, so like we never we are never into the fancy stocks like whether it is renewable or even a few of the oil companies. We were not there. And even recently, if you look at ITC, where government has mentioned about the taxation and when a stock like ITC has gone on, I'm not focusing on that, but we tend to avoid sectors where government had a lot of interference and we didn't had much of say on to that. Okay, so these were the factors that narrowed down our choices, and remaining what was there, we selected leaders. Okay, and our focus was on to stay into large caps. That helped us because the drawdown was lower and selective mid caps. Okay, so that was our idea what we had applied till last year. Now the thing is that the valuation, as Sagar mentioned, yes, we have underperformed valuation wise. We are looking good. Now it will be a time where we can go aggressive and take exposure to few mid caps where we see yes, growth would be there. Yes, that's it from my.
So the other part of the question also is that is there any max investment limit for the small case? No, not at all. You can invest any amount of money there. And do we plan to add gold and silver themes in form of ETFs or FANG ETF based on change in market trends if needed? So for these ETFs, I think we've got another small case which is called all season small case, which actually combines multiple asset classes. So we usually take exposure across equity, debt, gold, as well as foreign exposure in that particular small case. So that's something which plays these trends more actively compared to the value migration small case, which is the mandate is equity. So we don't really we stick to our mandate and don't really diverge into other asset classes for this small case. But all season is also one of those small cases which has done probably actually extremely well because we had exposure about 5 to 10% exposure to gold, as well as about 5 to 10% exposure to Hang Seng. So we were very beautifully placed for 2025 in that small case. Also, we had more exposure towards large caps compared to mid and small caps. So overall, if you look at the all-season small case, despite it being a multi-asset small case, we've been able to deliver double-digit returns in that, even beating Nifty 50 in a bad year. So we're there. That's something you can consider picking up if you're looking at a more diversified play. Um, the next question is from Jagdish, who wants a view on copper, aluminium, metal growth or demand expected in 2026 and further years. I'll probably again let Prasanna step in because he recently turned positive on metals, and that's reflected across his portfolios, whether it is in the small case or across our other products. He's actually someone who's also held on to Vedanta, not strictly for the metal story, but also for the restructuring and the demerger story. So I'll probably let him take the question on commodities.
Yeah, for metals, we had been positive. I had mentioned about the reason that government was about to take off was good. But then if you are only looking for a commodity kind of investments, I won't advise this is the right time to enter commodities. But then commodity based companies still look good because the earnings are yet to come in, and that would be visible in next 1 or 2 or 3 quarters, I would say. So as far as uh, commodity plays there, I'm not in for entering right now as a pure commodity play, but yes, commodity based stocks still look good because that is what our metal index is formed of, and we are having long on metal index right now.
Thank you. Devendra's got one more question, which is what is the investment thesis in satellite small case? As some of the stocks were sideways or downtrend for a decent duration over some time before they were exited, or few turnarounds considering current markets. So the satellite small case, see, primarily is something that is a very complementary portfolio to your core portfolio. The approach in that is that there should be a core. I mean, the basic philosophy is of a core satellite. So your core holdings are those that you've got for the long term, that you're holding on to from a 3 to 5 year or more perspective. And then we've got a bit of a side gig, which is the satellite portfolio, which shouldn't make up more than say 20 or 30% of your overall portfolio, depending on your risk appetite. So the satellite portfolio, typically what it does is it invests in, at any given point in time, between two and four stocks, with an objective of making a quick buck. And that quick buck is not really intraday, but it's slightly more positional in nature. On average, what we've seen is that we've been able to exit stocks on a 2 to 3 month basis. Our average holding duration would be somewhere between 2 and 3 months. And the average return we've earned on every stock that we've taken so far over the last 2 years of running this product is about 9%. So primarily, I think it's a combination of both fundamental and technical. Again, I think I'll let Prasanna take the details in terms of what categories he or what parameters he looks at when it comes to fundamental and technical both. But the basic thesis is that it's something that will keep revolving. It will keep actively churning. And it'll keep generating either high single digit or low double digit returns, and we'll exit. Sometimes here, obviously, we our win ratio is not 100%. Our win ratio has been about 75% in this particular small case. So 1 out of 4 times we do go wrong. But the important part is, or the objective is that number one, you should be cutting your losses early enough if you've gone wrong. And number two, the amount of exposure to that wrong bet should be contained and should not really be a major part of the portfolio. So as long as we're managing risk by managing weights as well as by managing downside, and by trying to achieve more than a 50% win ratio, I think we should be ending overall on a pretty positive note like we have. So I'll let Prasanna just highlight brief parameters that we look at when selecting a particular stock in the satellite small case.
Again, as Sagar mentioned about the satellite portfolio, the objective is very simple. Okay, so again, we are not getting into very complex things. So the basic necessity for getting selected is a simple risk reward ratio. Okay, So when I'm speaking about risk reward ratio, unless and until it is I'm having a 1:3 kind of ratio, so where I'm putting up 1 rupee at stake and earning 3 rupees, then only it actually gets selected for our recommendation kind of thing. Okay. So what happens is in sideways market, which we have seen for last 1.5 year, in such scenarios there are still good opportunities. There are some pockets where momentum kind of thing is available. Okay, so we try to catch that momentum, and whenever we get 1:3 kind of ratio on technical basis, and fundamentally if that passes are very, there are only 3 4 things that there will be a consistent growth in terms of revenues, margins are stable for 2 or 3 quarters, and apart from that, a good sector, as I mentioned, means we play sectoral themes. So all these three fundamental things come up, and technicals. So fundamentals is giving me what to buy, and technicals is suggesting when to buy. That is what the basic idea is. Okay, so not I'm saying that we are getting exactly the complete move of. Means if it's like that sandwich where I get the middle part is better, so I get try to get that 60 to 80% kind of returns, and let that plus means initial 10% and last 10% kind of returns will let go. So what happens if a stock is selected and we get 10 to 12% within a month or something, we try to book profits. Okay, now this strategy has helped us in sideways market, and there are 1 or 2 cases where we exited and then the stock still moved up, but then we have entered other better opportunities, and it gets compensated. So last 2 months, or we can say around 60 to 80 days, there are sideways stocks which we have seen, means where we have current exposure. But then my risk reward, as I mentioned, means we apply strict stop loss, and if that gets triggered, we exit. So when it is 1:3, if I'm losing even at 3 stocks, I'm losing 9 rupees. But then in other seven, I'm earning 21 rupees. So that is the basic idea. And in current markets, it played well for us. But as I mentioned, that we are going to get aggressive in most of the funds, and so I guess churning would be higher in terms of satellite going ahead as well. Thanks.
So just to add to that, I think given the fact that we also set a parameter from a screening perspective that we'll select only fundamentally good stocks, that also reduces a lot of the risk that comes from selecting stocks that are not great from a fundamental aspect. So there's that. So Ahmed's got a question saying, is Voyager's philosophy different compared to small cases? I had invested in June 2024 and return since inception is -3%. So I think it's no, the philosophy is not quite different because at the end of it, at a group level, our philosophy is pretty simple. We like to pick up stocks from the perspective that they'll deliver both superior earnings growth as well as a valuation re-rating. They're held from a 3 to 5 year perspective. The portfolio is diversified and cushioned enough from a market cap or sectoral composition. So we pretty much follow the same things. I think it was the return that you're seeing is primarily due to how the markets have been, because June 2024 till now has been the period that has sort of roughened out. In the difference, I think, also comes about because value migration as a small case is a model portfolio, right? So that return, again, while the model portfolio has given a 20% return, the returns may vary from client to client depending on when the entry point and exit points are. So I think it's plainly due to different time periods. But otherwise, I don't think there's anything to worry about. It's just same philosophy, similar, I mean, approach in terms of investment, same team as well. So I think we'll recover the losses and deliver more in 2026 as things get better. Um, So Kamlesh Jha's got a question. Some of the scripts in Voyager's code portfolio is down by a big percentage, like Reliance Infra. Any view of that? Overall portfolio is saying is also holding good. Sorry, I didn't mention that. No, so overall, I think, one of the things that we are very conscious about is the fact that when there is some stock that we're picking up that is a little high on risk, we actually try to make up for risk mitigation by containing the amount of weight we assign to that stock. So if you look at Reliance Infra, probably at this point in time, you would have exposure to about 2.5% in Reliance Infra. So from that angle, I think we are capping the amount of exposure to such stocks, even if we are taking some bold bet at some point in time. But at the end of it, at a portfolio level, we sort of ensure that risk mitigation is taken well care of, and the other holdings are making up or offsetting more than what we've lost in that one particular stock. And I think that's reflected in your comment itself, right? That the overall portfolio is doing better. Maybe on Reliance Infra specifically, why we're still holding on to it or what we see from here, maybe I'll let Prasanna again take over. Uh, but at a broader level, that was the view. Prasanna, any comments specifically on
Yes.
Reliance Infra?
Yes. The thing is, look, what happens as Sagar mentioned. So, we try to take risks in some of the counters. Okay, so what happens? There are possibilities of turnaround or even management changes or takeovers. So, what happens? Such news-based or even momentum-based plays are part of our portfolios. But again, as even Sagar mentioned, that weightages is what we try to maintain on that. Okay, so similarly, Reliance was part of it, but right now the stock is into ASM, and we are trying to take a call exactly because there is no acceptance into NCLT till now. Okay, so and exchanges haven't provided any reasons why it is into ASM. So there is still a confusion on based on that why it is into that, and only Monday it trades and it is at the lower circuit. But as soon as the things get cleared from on the from the part of NCLT, whether it is added to it or it is not, there will be a lot of clarity arising on that. So it may provide some support, and yes, it is down by more than 50%. It's true, but recovery, if it comes, will be better if we get clarity. So there is still no clarity provided by NCLT and even from the management. So we are awaiting for that. And what gives me cushion is that only less than 3% of weightage provided to that. So that's what we are taking that risk. Because if it recovers and starts moving, means if the change of management or some turnaround is visible, it would be one stock which will provide good returns in 2 to 3 quarters. That is what our idea is. But if it is accepted into NCLT, yes, we need to exit, and that will be the call will be taken.
What we can do is, after this, we'll send you the presentation and a short mail asking for some feedback as well. Would be great if you guys could pitch in on that. That will help us improve the content, set a frequency, see what to cover next, and figure out how to improve this engagement on a regular basis. Um, so thank you all for joining in. On an additional note, special sort of mention from the marketing team here that we need to mention our YouTube. If you like this, you will like our YouTube channel as well. We do a weekly podcast on it. So you guys can go ahead, subscribe to that. And that will help us get more encouraged to show our face and give you insights on a more regular basis. Um, these sessions, Jagdish, happen. I mean, we haven't decided a frequency. I hope it's quarterly. But if you guys give negative feedback, we'll sort of reduce the frequency as well. We'll see. I mean, I wrote quarterly there, but the aim is to do it quarterly, but we can figure a frequency out that is suitable for both us as well as investors. All right. Thank you. Thanks so much for joining in on a Saturday. Have a great weekend. Thank you all. Really appreciate it. Thank you.